Joining us now to talk about the tariff impact on the markets and more is Mira Pandit, JP Morgan Asset Management Global Market Strategist. Mira, JP Morgan Global Economic Research had a really great piece yesterday where they said the sector-specific Section 232 tariffs are likely to have a much bigger impact on the effective tariff rate than country-specific tariffs, and they think it'll settle around 22%. How much do you think that is borne by the consumer? And how much of that will be taken in from margins from the companies themselves? And what does that tell you about the stock market?
In aggregate, we're expecting that around 60% of the overall cost of tariffs gets passed on to the consumer, and the companies retain about 40% of that. But certainly it will be carrying the load on both sides and have an economic impact when we think about the consumer and also profitability. But what we do get coming into next year is a bit of a tailwind for both the consumer and corporate profitability when we think about the tax cuts, because there are some sweeteners in there for consumers, which should help lift consumption and help growth. There are also some sweeteners in there for corporations, reviving a lot of provisions from 2017 and potentially helping profitability here. So while the cost from tariffs may increase as we go throughout the rest of the year, as you get into next year, it may actually be outweighed by some of the benefits from tax cuts for the first half of the year.
But those two things sound like they could be inflationary as well. Is that a concern of yours?
It is. I mean, when we think about what the Fed's reaction function is here, we know that the jobs report got a lot weaker more recently, and it's not just one number, it's really been the trend when we think about those revisions. But the reality is we're still in this sort of no hire, no fire, I'd add no supply market when it comes to jobs, and maybe we're in more of a standstill as opposed to a decline. But when I think about inflation, we're probably going to continue to see goods costs rise. You might see a lift, but then a shift away from areas within the services that may help inflation fall by the end of next year. But if you also see a boost to growth and inflation often move in the same direction, that may keep inflation elevated in the first half of next year.
And of course, what does that tell you about kind of the Fed and its trajectory for rate cuts? If we're looking at elevated inflation next year, the market's pricing in 3 rate cuts here. Does that kind of pour cold water on that notion?
In our mind, it does, because it's not only about what happens for the rest of this year. Do you see 1 rate cut? Do you see 2? We probably wouldn't see more than 2 given that inflationary picture. But as you get into next year, if inflation's being held higher, if growth is actually accelerating, even if just for a shorter period of time, does that further push out even more rate cuts to the back half of the year? And then overall, do we see fewer cuts than the market is anticipating, not only for this year, but also for next year?
Do you get the sense that the cracks forming in the labor market are also temporary if you're expecting, growth to accelerate, inflation to accelerate? Or do you think that's just a part of a bigger complex picture?
It might be part of a bigger complex picture, but what we see in the first half of next year is that if growth is a little bit higher, potentially that extends the life of the labor market a little bit. But they're somewhat separate in that the tax cuts will very much help out consumption. But if you still have a labor market that's overall weakening, there's a question mark there. A lot of the tax cuts are going to potentially spur CapEx and investment. How does that pass through to hiring? We're not quite so sure. But ultimately, even if the Fed is not cutting as much as the markets think, I don't know how much that will actually help the labor market one way or the other. Because if you look at labor market data from last year on the JOLTS, it's basically exactly where it is today. If you look at this morning's initial claims, it still looks like there's not a lot of layoffs going on. And if you look at small business surveys, the NFIB, they rank the top 10 business problems for small businesses. Number 10 is actually interest rates and financing costs, whereas number 2 is quality of labor. So, and quality of labor is actually higher than the overall cost of labor as a business consideration. So I'm not sure how much a fluctuating rate outlook actually will help the labor market one way or the other. There are these different dynamics at play when you think about immigration, demographics, that's actually also slowing supply. It's not just that demand is also getting a little bit more anemic.
Yeah, especially if market rates stay high as well. Mira, thank you very much.